Hi, this is Bill Polis from Profits Run, and welcome to Options Profit Mastery training video number 2. In this training, I'm going to teach you an options strategy that's all about protecting your portfolio from market collapses so that you'll never suffer an account crippling loss again. It's kind of like buying insurance on your portfolio. Make sure you take good notes because once you learn this strategy, you'll never place a trade without it again. It's that good. And I'm also going to reveal what I consider to be the number one mistake that sabotages most options traders. Once you understand what it is, it'll be almost impossible for you to place a high-risk options trade ever again. And I'm going to pull back the covers and give you a little tour of my Options Profit Mastery Trade Candidate software so you can see exactly how it can help you save a ton of time when it does all the heavy lifting associated with finding the safest and best stocks and ETFs to trade. Every night after the markets close, it scans thousands of markets and shows you the best opportunities for all 12 of the Options Profit Mastery strategies. If you haven't watched training video number 1 yet, make sure you go back and watch it after you're done with this video. It reveals how you can exploit an upcoming market event that gives you the potential to make double and triple digit returns in as little as 1 day. You don't want to miss it. So let's dive into video number 2 and continue the training. Okay, so here's the number one mistake that sabotages most options traders. Most traders abuse the leverage of options and allocate too much of their trading account to a single trade. Let's look at a quick example so you can see what I'm talking about. Say we have two traders, Susie and Sammy. Susie is a stock trader and has to risk 27% of her account or $4,000 to control 100 shares of a stock. Whereas Sammy, who's an options trader, is able to control those same 100 shares by buying just one call option, risking only 2% of his account or $300. But here's where most people get in trouble with options. Let's say Sammy gets greedy, which is very easy to do when you have a few big winning options trades. And instead of just risking 2% of his account, he risks over 1/4 of his account, buying 14 calls instead of just one. Now his maximum loss is $4,200. So yes, if he wins, he stands to make a lot of money. But the whole point of options is to strictly limit risk. So if you risk too much, you're missing the entire point of options trading. And all it takes is one losing trade to wipe out all of your past gains. That's why risk management is so important, especially with options. So an easy way to avoid this number one mistake is to use this time-tested risk management strategy. Again, keeping in mind Einstein's rule of simple is better. Never risk more than 2% of your account on any one trade, or 5% for accounts under $10,000. That's it. If you stick to this simple rule, it'll be impossible to experience an account crippling loss. And that's one of the secrets to getting rich slowly, which is something that's within the grasp of almost everybody and a concept that I'm a big fan of. Now, I've never believed in the get-rich-quick mentality, and that's why all my training and programs are based on realistic, sound principles that can give you an edge over everybody else trying to make a quick buck. In the first video, I taught you how to trade straddles, which is a great strategy to use if you think a market is about to make a big move either up or down. And now I'm going to teach you another great strategy called protective put options. Now, this is all about protecting your portfolio from market collapses so that you'll never suffer an account crippling loss again. It's kind of like buying insurance on your portfolio. So let's dig in and let me show you how it works. So what I've done here is just sketch out the risk curve for a protective put option. This is the one on the bottom. But let's set the stage. On the top here, what we have is the horizontal axis is the price of the stock that you own, or you could consider it your whole portfolio as it's priced at the current market right here on this horizontal axis. Now, if the market value of your portfolio goes up, you're going to the right here and you're going to be profitable. This is the value of your portfolio. If the market value drops, well, then you're going to be losing money. If it stays the same, you're at break even. That's how this risk curve works. So an unprotected portfolio has a risk curve like this. This line just comes straight on down like this. And what that tells you is you have unlimited upside potential, which is good, but look at the risk on the downside. In fact, your theoretical maximum possible loss is indeed 100%, because in theory, a stock can go to zero, and sometimes they do. And in theory, your portfolio could go to zero. Not likely, right? But in the last decade, 3 different times, your portfolio easily could have dropped 40, 50% or more, unprotected. Okay, now let's look at the risk curve when we buy a protective put. And so for this example, I'm assuming the stock position that we're protecting is valued at $40 a share. So we could have 1,000 shares of this, 10,000 shares, and it can represent your entire portfolio as well. But just follow along here. So we got a $40 stock. We're going to buy a 36 put. And so that's $4 below the current value of the stock. And we could probably get this put for 50 cents. Now, don't try to understand all of this right now in terms of the put and the price and so on. If you're new to options, it'll all come clear after a few more examples. But just know that when you buy this protective put, a 36 strike put, what happens with the risk curve is while you still have unlimited upside potential, but look what happens to the downside. It's capped. You can't lose more than 10%. I mean, the stock or the portfolio could go to zero and you would only lose 10% because all those losses would be offset by gains on the put. So this is a simple strategy to protect any stock position or any portfolio by buying protective puts. Now, these are insurance. If this market doesn't drop, then the put could expire worthless, and you would lose your 50 cents. Small price to pay for being able to sleep at night, especially in a dangerous world where our financial systems are a house of cards these days. Government spending out of control. And yeah, your broker or your financial advisor is going to assure you, oh, no, you're fine, you're fine. You're well diversified, you're this, you're that. The truth is they don't know, and they're talking through their heads. And you just ask them, what are you doing to protect my portfolio from a 40 or 50% loss? And you'll find they have no answer. Well, one answer, a very good answer, is protective puts. Now, to make this point a little further, here's just a little sketch. This could be the general stock market, the S&P 500. This could be a monthly chart. The market's making new highs. The world looks terrific. And then all of a sudden, it's 2008. It starts dropping. And then we have a severe collapse. Now, you could argue that, as many financial planners do, well, hang in there, even though you've lost 40% or 50% of your portfolio, hang in there because the market always comes back, which it did in 09 and 10 and 11. There's a big problem with that, though. The stocks you own or the ETFs you own oftentimes do not come back with the general market. Also, a lot of folks can no longer stand the pain, and right in here, they tell their broker, sell everything, I've had enough. Just exactly at the wrong time. Instead, if you bought a protective put right in here, then you would not suffer through this dramatic decline because your portfolio is protected. So you never would lose 50%. You might be losing 10% or 15%, protected by the put. And that gives you the staying power to stay in your positions or rotate into better positions for the ensuing recovery. So while everyone else is sweating blood over here, and some bailing out at the wrong time, and some really never recovering because their portfolios don't go up with the general market, you've got it all covered. Very, very powerful stuff. Okay, now let's use a real live chart to make the point further. This is the S&P 500 ETF called the SPY, SPY, nicknamed the Spider ETF. Now this is a monthly chart then of the SPY, which tracks directly with the S&P 500. And you can see here, the market's going along just fine. Starts to sell off, still looks okay. And then, oops, starts to fall apart right in here and then just collapses. Now, this is a real life chart. Now, this happens. And it's happened 2 or 3 times in the last decade, depending on the magnitude of the drop. It happened during the dot-com bust, and it will happen again. Okay, and then here's the bottom and the ensuing recovery. Now, you may have participated in this drop, whether you did or didn't. Ask yourself, how would you feel if your whole portfolio was collapsing by 50%? That's exactly what happened here. So for illustrative purposes, let's say you were long the SPY ETF here at 153.84. That would be right here in the month of October. Now let's say that represents your entire portfolio. So what you would do to protect that, and again, right at that point, there's no sign of trouble. But you could protect it by buying to open one March 139 put, about 10% below the current market value. If you take 10% of this is 15, that gets you about 139. And you're going to pay $1.90 for that protective put, with the SPY trading at 153.84. Now let's just follow along. Now you've got insurance protection, at least through March. And we're in October here, and then here's March over here. Now let's scroll forward at point B. We're in the month of March, and so we have to close out our March put. So we sell to close the March 139 put at a credit of $5.30 with the SPY at 133.12. So you see the SPY dropped a lot. It dropped 20 points from October to March. But the put gained $3.40. Paid $1.90 for it, sold it for $5.30. So it partially offset the loss in the SPY. Now remember, this insurance policy is catastrophic insurance. It's not going to offset the entire loss, but it's going to prevent a catastrophe. Now at the same time we close out the March put, we buy more insurance. So we go out to the July put now, which takes us out into this area. So we're going to buy to open 1 July 139 put, the same strike price, at $9.80 debit. Now we have to pay more for it because the SPY is actually below the 139 strike. But that's okay. It has more value as well. Then at point C, we need to exit the July put, and we can do so at $13.10 for a credit because now the SPY's dropped even more by $6. So we have a $3.30 gain on the July put and a $5.81 loss on the SPY. At the same time, we're going to buy to open the December 139 put at $14.70 credit, with the SPY trading at 127.31. So we continue with our insurance policy. And notice we're starting to offset more of the losses, a greater percentage of the loss. Okay, then come December, right in here, we're going to close out the December put for a gain of, look, $34.90. Because why? This is where the collapse occurred. And our December 39 put that we paid $14.70 for is now worth $49.60. So we have a gain of $34.90 that almost offsets the entire loss on the SPY position at 37.69. But we're not done. We're going to buy the March 139 put now for $51.50. And then come March, we close out our 139 put at $66.50. Gives us a gain of $15. The SPY loses another $16. So now let's add it all up. So let's add all of the gains from our protective puts. That's $56.60. And all of the losses from our long SPY position. That's $80.29. Now watch this. Without buying those protective puts, your SPY loss would have been 52.2%. By having bought the insurance along the way, that loss was cut to $23.69 or 15.4% with the protective puts. A dramatic difference. Now let this soak in because this is going to happen again. We don't know when, but it'll happen, and you want to be prepared when it does. Let's look at another example. This is a daily chart of the SPDR ETF or the SPY. And let's assume we're long the SPY at 201.82 right here. So we're looking now at a much shorter time horizon than we did on the last chart. And everything looks fine here in the market. But we still want to buy protection because we're concerned about a drop. You know, the Federal Reserve interest rate policy, geopolitical events going on around the world, anything can disrupt the market. So we're going to buy to open 1 December 180 put. Again, that's about 10% below the current price at $1.80 debit. Pretty cheap insurance. Okay, then the market sells off abruptly and just as abruptly comes back. Well, at this point, we would sell to close our 180 put, our protection. Why? Because after you get this kind of a snapback rebound, the probability of the market going lower from here is not high. The probability is that the sell-off is over and it's going up. So we sell to close our 180 put for a credit of 90 cents. We paid $1.80 for it, so we lose 90 cents. The loss in the market is $7.75 because the SPY dropped from 21.82 to 194.07 right in here. So what's the point of this example? Well, you didn't really need the insurance here, as it turned out. But that's unknowable at this point here. This market could have dropped to here, gone here, and then dropped again, like it has done many, many times. In which case, you'd be very happy to have that insurance. But you didn't need it. But look, it only cost you 90 cents. And of course, all of these examples assume one share of the SPY. If you had 10 shares, that would be $2,010. If you had, 100 shares, it'd be $20,100 and so on. So when I say 90 cents, I'm talking about per share. All right, one more scenario. So here's the market moving up very nicely. No concerns. But let's say, you know what, I still want to buy some insurance. So we buy to open an October 175 put. By the way, this is a daily chart. And we're going to pay $2.70 with the SPY trading at 192.68. Again, this is about 10% below the market. If we bought an at-the-money put, right at the market, we'd have to pay too much for it. It'd be like overpaying for insurance. Remember, we're not trying to insure against minor drops in the market. We're trying to insure against major drops. And that makes the insurance very affordable. Now, this market just, continued to grind higher. It did sell off here and then moved on up and so on. And what I want to point out here is, again, what happens to our insurance in a market that generally, other than this short-term drop in here, just continued to go up. Okay, so remember we put this October put on here in the month of June, and October's way over here. Now we got to close out that position at point B. We could have closed it out anywhere, but let's say we closed out at point B, and now it's only worth 15 cents. So we get 15 cents. The SPY's at 197.02, up from where it was when we put the protective put in place. And so what happened? We lost 255 on our protective put and gained 434 on our open position for a net gain of about $1.80. This is all in a market that really didn't go anywhere to speak of, kind of stuck in a range. So did you need the insurance during this time? No. Did you know that ahead of time? No. Isn't it nice to have the insurance? Even if you don't need it, you still end up ahead because your market gains will offset most of the time the cost of the insurance. If the market does collapse, you'll be darn glad you had the insurance. Now, you can use other techniques to alert you to the potential for a market collapse. And when those techniques alert you, put the insurance on at that point. Now that's a little risky because you might miss it, but it is a way to avoid buying insurance when you probably don't need it. So I hope you're beginning to see how powerful these option strategies truly are. I really began to appreciate the power of options when many years ago I attended a high-priced seminar by a noted options expert. He asked all the attendees this question that I'll always remember. Why would you ever trade a stock again once you know options? Well, indeed, once you know options, it's hard to go back to just trading stocks. Now, it's important to note that you can still do really well trading stocks too. So there's nothing wrong with that. But options trading lets you truly leverage your money, almost unlike any other kind of trading. And don't forget, I've only shown you 2 strategies so far. There are 10 more that are part of my Options Profit Mastery program that are equally powerful. So when you combine all 12, you'll have the power to spot profit potential in nearly any market condition. I'm about to give you a tour of my Options Profit Mastery software, but first I want to briefly cover another simple trading concept that's kind of like a final check you can do before you place a trade to make sure the odds of success are in your favor. If you've been my reader or student for a while, then this should be familiar to you, but it's so important, I want to make sure we cover it here. The concept is this. You should only place trades in what I call a deliberately trading market. Let me show you what this looks like. Okay, here's a market where day by day, the price action is fairly similar to the days before and the days after. Or it could be hourly bars, or it could be weekly bars, or weekly candles, or monthly candles. It doesn't matter. Any chart could be any stock, any ETF, any time frame. The point is that candle by candle, the price action ebbs and flows in a deliberate kind of fashion where you don't have what I call unusually wide range candles that are several times wider than those that precede or follow it. You don't have gaps in prices. Now, a deliberate market doesn't have to be going up. It can be going down as well, as long as the price action meets the deliberate trading criteria. Okay, now look at this chart. This is an example of a market that is definitely not deliberately trading. This thing looks like an electrocardiogram. It's a helter-skelter kind of price action that jumps up, jumps down. You've got unusually wide-range candles all over the place. This is a dangerous market to trade, and there's no point in trading it. I think you can readily see the difference. So what most people do when they try to place a trade is they just apply whatever method they're using without regard to understanding deliberately trading markets. If you're unaware of this concept, you've probably done this too. And even if you have a proven trading method, the odds are stacked against you if you attempt to trade a non-deliberately trading market. But if you only trade in markets that are deliberately trading, the odds are overwhelmingly in your favor. This concept is such a big deal that one of my longtime students, Dr. Bruce R., wrote to me expressing his thoughts. Here's what he said. I've used Bill's concept of deliberately trading markets for some time now. It cannot be overstated how effective it is. Do yourself a favor and start practicing analyzing every chart you wish to trade in this manner and see the difference for yourself. You won't be disappointed. Dr. Bruce R. Well, thanks, Bruce, and I would definitely encourage you to take Bruce's advice and start applying this concept to every market you're about to trade. I think you'll be surprised what a difference it can make. So now let me give you a sneak peek at my Options Profit Mastery web-based software. I call it the Options Profit Mastery because it totally automates everything you're learning in these videos, plus a whole lot more. Also, in addition to being able to use it on your Windows or Mac computer, it also works on pretty much any modern digital device with internet access like iPads and iPhones. That's why I like to think of it as a personal trading assistant that taps you on the shoulder when it's time to trade. This lets you go about your business and really not even think about trading until something really good is about to happen. Finally, all the mystery, confusion, and complication normally associated with options trading is removed. Let me give you a quick tour. Every night after the markets close, it applies my filters for all 12 of the Options Profit Mastery trading methods to the best stocks and ETFs to see which ones would make good trading candidates. Then it displays the Matches on the Trading Candidates tab, which you can see here. The Filter Name column shows the specific strategies you can use with the stock or ETF that is a good candidate. You can see there are several matches for protective put options, which you just learned about in this video. I'll reveal the other strategies that are blurred out very soon. The Stock ETF column shows the symbol for the stock or ETF that made the cut, and you can click on the symbol to see an interactive chart. The latest price is also displayed here. The average column and the first appearance column tell you how recent the trading candidate is. Depending on the strategy, some of the candidates may still be good to trade for as long as 30 days, so you don't need to worry if you're busy and miss one here or there. Also, you can choose to have the newest candidates sent to your email or cell phone, so you don't have to keep checking the software for updates. Remember, the goal here is to teach you how to master options trading, so the software is only a tiny part of the overall program. You'll love using it to save time to quickly find trading opportunities to try out with all 12 of the strategies you'll be learning. At this point, you might be wondering if this is an auto-traded system or a trading robot or an expert advisor, and the answer is no. These things are usually cheap, gimmicky $97 plugins that claim to make you rich while automatically trading while you sleep. The reason so many of them littered the market a few years ago is because they're relatively easy to program and the low $97 price made it an easy sell. So the robot makers would keep cranking these things out, misled people would fork over another $97, and the cycle repeated itself until everybody pretty much realized that robots were really more about entertainment than serious wealth building. And that's why I've never released a trading robot. So in contrast to a trading robot, Options Profit Mastery is all about teaching you how to trade. The software is really just like a set of training wheels on a bicycle. It'll help you spot the best trading opportunities each night, which will save you a ton of time, but the actual trading remains safe in your hands so you always know what to do. And if you've used other trading programs of mine in the past, then you probably have experienced what happens. The more you trade, the more it becomes second nature, and before you know it, you'll be able to actually spot the trades just by glancing at the charts for a few seconds. It's just a great way to learn how to trade in a step-by-step, handheld fashion. Okay, we're almost done with this video, but I just want to quickly address one of the common concerns I hear from people about options trading, and that is, isn't options trading awfully complicated? Well, like everything else, options trading is pretty easy once you get the hang of it. However, there's a lot of new terminology and concepts you need to learn if you're brand new. But as you've already seen, options trading can be quite simple when it comes right down to it. I've found that it's really helpful to go and learn how to trade options by example. And that's why I like to use a lot of examples in my training versus boring textbook theory. And even though most people don't properly understand options, major financial publications all agree that if used properly, options trading holds huge potential for your portfolio. Barron said, in a world of low economic growth with many investors wary of assuming too much risk, this year could prove historic for the options market. According to MarketWatch, by themselves, options are not dangerous. The danger is in the speculative strategies that some people use. Fortunately, the best antidote to risky option strategies is knowledge. And from the Wall Street Journal, options generate income and can juice returns in any market. A press release from TD Ameritrade said, more than 75% of all American investors remain unaware of the potential benefits associated with adding options to a diversified portfolio. And Bloomberg Businessweek published an article that said, selling options can generate extra income on your portfolio and may be one of the few ways investors can really enhance their returns. So as you can see, I'm not the only one who sees the huge potential that options trading has to offer. So I hope you're starting to get the picture about how lucrative my Options Profit Mastery program truly is. Just imagine going about your day like you normally do, coming home, spending time with your family, and then taking just a few minutes to place and manage your trades. This kind of trading literally takes just a few minutes per day at the most, and not every day. After you place your trades, you can sleep soundly knowing that you've done everything you can to manage risk and protect your money, while at the same time giving yourself the chance to go after double and even triple-digit returns, sometimes in as little as one day. Now, there's nothing else to do during the day, so your lifestyle isn't interrupted. You don't need to stare at charts. You don't need to spend hours trying to find trades. None of that. This is definitely one of the easiest, lowest maintenance ways to trade, and I can't wait for you to experience what it's like. So that's it for this video. I hope you enjoyed it. But I'm not done yet because I have a third option strategy that I'm going to teach you in the next video. This strategy may be the easiest of the three I'm teaching in these videos and is all about replacing stock trading with options trading, because once you learn it, you'll probably never bother trading stocks again. And I have some other surprises in store for you that'll make it easier than ever for you to begin using this program on your own. I think you're really going to love it. The next video will be posted shortly. In the meantime, make sure you understand everything in this video and go ahead and post a comment below if you like what you've seen so far or if you have any questions. For now, this is Bill Polis wishing you good trading.